Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show. Hey guys. Okay, we're back for another one. Good morning, guys. Welcome back. Hope you're doing well and staying safe in these crazy markets. Gold hit 3,000 last night. Not sure if you guys saw that, but we did in fact see gold for the first time ever trade above $3,000 an ounce. Very cool. Historic stuff. I mean, that is a huge move for gold here. I mean, recently, but just in the last few years. I mean, gold has kept up with, the returns of the stock market, which is really impressive. You got to think, I mean, it's been a period of time where stocks have been phenomenal. And meanwhile, gold has actually done very well too. Here's going back from here's 2016 to now. If you've just sat holding gold during that time, like 2016, you bought some gold, you're looking at 155% return on investment on like a super boring, stable metal. It's crazy. Now, the downside to gold is that it doesn't yield anything. If you buy certain stocks, they offer you like dividends, so you get paid just to hold them. But who really cares when gold is moving like this, right? You got gold moving like that. Who cares you're getting dividends if the thing is just going up and up and up? I don't think it'll go up forever, but recently, we've been very bullish on the show on gold. Stand with the trade here. I did trail my stop loss yesterday. Took my stop from down at 28.25. I've moved it since up to the just below the lows of yesterday's price action, right? So pretty much started out yesterday and just exploded higher. Gold was able to break that 4-hour chart level of resistance that we kept talking about. You can see there it is, right? So we broke that resistance right here and no pullbacks, right? This can be very frustrating at times for the break and retest traders like myself. I mean, from a technical perspective, that is typically how I like to enter a trade. I mean, technically, I did enter this trade from a break and retest. It was just on the daily chart, right? So this breakout retest, I went in on this and continue to hold the trade. I mean, for me, gold looks very attractive. On my system, the Edge Finder here, we've still got a very bullish reading, a +10 score, very strong reading overall. That's telling me that most of my factors here, economic data, technical reads, sentiment reads, are pointing bullish for gold at this time. So I continue to really like the setup. I do think gold can keep going. A lot of times people will see a big move like this, and man, how many times have I repeated that on stream? A lot of people think when gold makes a big move, oh, it's got to come back down now. It's gone too far. It's stretched. It's overbought, right? Just to watch it do what it has done for the last several years. You could have pointed to a million different times where gold looked overbought. Meanwhile, it's having one of the best runs that we've had in decades, right? I mean, gold has not made this kind of move since back in the great financial crisis, pandemonium, right? That's the last time we got. I mean, this is sharper than that in some ways. Gold is absolutely ripping. Again, that's probably, in my time trading, the best performance I've ever seen for gold has been in the recent 2-year period or so. Well, couple year period, going back to the pandemic, right? We had the pandemic sell off, every kind of assets across the board sold off, you can see, but gold recovered it very aggressively. Continues to be one of my favorite things, both long term and short term. Gold is one of my favorite things to trade, but also to hold long term. That being said, for me, long term, gold is probably not as attractive at this time. But if you get a larger pullback, you know, metals can have ugly drawdowns and pullbacks just like everything else. Even in this up trajectory for gold, we've seen pullbacks. There's a 9% pullback. In 2022, you had a pretty good sized pullback with the inflation stuff, right? So from peak to trough here, you had a 22% pullback in the price of gold. Going back from here, was it any worse? Yeah, about 22%. So at 22% pullback, that's still better than the stock market. During that time, stock market was down about 28% peak to trough. So gold has just had really impressive performance. Again, the shiny metal just keeps winning overall. That being said, doesn't mean that it's impenetrable to selling and pullbacks and things like that. But for me personally, like I said, I've been long on gold here for the last week and a half or so. My stop is below that kind of big shoot to the upside that we saw yesterday. So if we come back and fail at this area, in fact, I actually may look to, if we get a nice closure today, I'm probably going to just go ahead and move my stop up just behind this market structure here, the previous all-time high, 29.50 or so. But I mean, this morning we were trading the 3,000s. We may do a little bit of a 3,000 pullback continuation. That would be my opinion. Just because something is overbought does not mean that it cannot get more overbought, right? But I wouldn't be surprised if we saw gold do one of these guys, pull back and continuation. I exited at 29.70. Yeah, I mean, that's the thing. Silver looks really clean. Yes, it does. It looks great. Take profit on gold. I have no take profit on gold. Gold could go to, if it went straight to 4,000, I would continue holding it right now. I don't use the take profit in my trading because as a trend follower, I don't really believe in trying to call the top of a good move or the bottom of a good move if I'm bearish, right? If I have a trade on, reason I trail stops, right? This is not a take profit order for me. The reason I trail stops is because look, gold could be making a substantial breakout here. And the most annoying thing I could possibly do would be to say, oh, it hit the previous all-time high. Let me just close out. And then it does this, right? Calling, if you're right about something, in my opinion, if I'm right about an idea in the markets, I want to hold it and let it run, let it do its thing, let it keep going. As a trader, that is pretty much my approach, is like, if I'm trading something, if I'm right, hold on to it. And if I'm wrong, let it go. That is my philosophy on short-term trading, which I would consider short-term trading. Anything under a 30-day holding period is short-term, right? If you're position trading, you're holding for 30 days or longer, it's a little bit different. I mean, many investors also use momentum, but for me as like a trader, I like to use kind of the momentum of the day, momentum of what's happening, and hold on to trades that are working well. Double-edged sword could come back against you. Everything is a double-edged sword in trading. Every single thing has a pro, has a con. There is nothing, perfect about anything. You might say, well, what if I take partials? Then I've beaten the system. I take partial profits on the way up. Well, sure, but then I would just argue partials are the same thing as a trailing stop for the most part. If you're taking partials, let's say you went long here, you took partial here, partial here, partial here, you only have a little bit left, right? And then, you let that one run, it keeps going crazy, great. But like you have nothing left on the trade, then you might as well, in my opinion, it's the same thing as trailing stop. If you're taking partials along the way or just holding the full thing and you get this whole thing, you're still in the full trade and you trail stop and take it here, the P&L is going to look pretty similar. Trailing stops and partial profits, in my experience, looking at a lot of equity curves, they're very similar. Partials are very similar, right? So just something to think about. Just something to think about. Guys, I've got some interesting stuff to talk about here today. I have a video planned that I'm excited for. Look, I'll give you a little sneak preview. I think this market is, I think this is a great setup for longs. This is my opinion. I'm not talking about a short-term momentum trade. I'm talking about position trades. I'm talking about long-term positions that I like after this recent pullback. I have a whole list of things that I'm going to do in today's video. I've planned out my video already for the day, and I'm really, really excited for it. This big sell-off, I actually think is a great opportunity longer term to start building shares in stocks that I like. And that's what I've been doing. I've been buying a lot of stocks here recently. I'll show you my list. Also, by the way, I got assigned on PayPal. I need to just really quick. So I sold puts on PayPal and I got assigned here this morning, which is exciting. If you don't know what I'm talking about, assignment, when you short a put or sell a put to someone else, if the put becomes in the money for that trader and they exercise their put options, as the put seller, I have to buy the shares at the agreed upon strike price. So I got assigned on something here this morning. So that means I have PayPal shares. I'm just going to really quick update that because I just remembered that I had that happen. Let me just do this. It's assigned on my PayPal short put position. I now own 200 shares of PayPal at $76 minus the premium that I collected, which was $1.70. So my average in premium, so my average shares, I now own 200 shares at $76 equals to, what is my average share price? Because I don't want to do math. What is that? 74.30? Is that right? $74.30. I think that's right. My quick math. 74.30. Yes. Okay. I know, bad math, but if you ever try doing math on camera, I don't know what happens. You just lock up. Like when you're trying to quick think, speak on camera, and do math. Like I'm not like amazing at math, but I'm not bad at math either. But man, the second I got to do math on camera, it's awful. So I got assigned on some shares here this morning for PayPal, which is actually what I wanted to happen. PayPal, I bought, or I shorted puts at 76. I got assigned my shares at 74.30. So I am in a loss on this position currently, but this is a stock that I don't mind holding for the long term. PayPal shares are down from their highs about 28%. And that's not their all-time highs. That's like their 52-week highs. Long-term highs, PayPal has just a massive drop of 78%. So I'm buying shares now. I mean, this stock has gotten crushed since its excitement days of 2021, where everything was going parabolic. But I think indices have upside from here. I don't think that this is going to be a major market crash. And that's what the headlines will have you see. That's what the market sentiment will have you see right now. People are terrified. We've been talking about this on stream days after days after days. And I have been more recently pretty aggressively buying the dip. My portfolio is pretty much flat on the year. Oh my gosh. Oh my gosh. The put to call ratio. This put to call ratio is going to make me go buy more stocks. Look, everybody's terrified of the stock market right now. Not only that, here's your evidence. Put to call ratio just jumped to 1.03. People are buying puts and they're paying massive premium to buy those puts. People are scared. People are convinced the market's going to crash. Everybody is. The crowd mentality is market crash. It's happening right now. Look at the AAII Investor Sentiment Survey. We got this yesterday. This is 3 back-to-back weeks where investors are somewhere around 60% of investors responding that they feel bearish on the stock market. I mean, look, that doesn't guarantee that's going back up either, because technically sentiment has been kind of decreasing or getting more bearish in recent weeks. But I think we're crescendoing here. I personally, I really do think that we are closer to a bottom here than many people think. like I said, I've been buying the dip on a lot of stuff. I bought IGV, which is a software ETF. I've been buying a lot of individual stocks that I like. So, maybe I'm right. Maybe you tune in a week and I look like an absolute fool for coming up on YouTube in front of, 485 people. That's between Twitter and YouTube. Everybody who's watching, maybe I come up here and I say, look, I'm buying stocks. And next week when they're down, if they're down here, I feel, or I look like an idiot. But honestly, if you have a long-term goal, this to me is the time to start buying stocks, not to start selling them and panicking and freaking out. Look, you finally got a discount. Everybody wanted to buy stocks here, and now nobody wants to buy them here. That is trading psychology 101. People get scared and they sell their stocks. And what people I've seen all over social media, man, people are saying, well, I'll just sell them right here because they're going to go much lower and then I can get much better prices. And then what they don't realize is they're falling into the same trap as thousands and thousands and millions of traders before them who think that they can call the bottom and tops of stock market pullbacks, right? Stock market's been selling off hard. Am I looking to short-term trade this with a momentum, with a trailing stop? No, I'm not. But long-term, there's some stocks that I've been waiting to get a chance to buy that I am looking to now deploy capital in. Short-term trading, I'm still long gold. Like this is all this uncertainty has been excellent for the gold trade that I'm in. I've got a stop loss trailing on this one. I'm going to let this one keep running and I'm going to trade this. And at the same time, I'm going to pick up shares in the stock market for the long term. That is pretty much my job right now, quote unquote, as a trader, as an investor. I do both. On the investing side, though, again, people are terrified, and that's why I think you're if you do get a bounce, it's going to be violent, it's going to be quick, and everybody who's been saying, "Oh, I'm going to sell my shares and buy them back later," is going to look like an idiot. That's my opinion. I could be dead wrong. Like maybe I'm the idiot in 1 week, but in 1 year, in 5 years, in 10 years, I think the only idiots are going to be the ones who, like I said, panic sell and just let headlines guide their opinions on what to do in the markets. And again, when I'm buying in the stock market, I'm not leveraged up. I'm not taking silly risk. I'm taking, I've been accumulating shares as the stock market goes lower. And I'm not short term with it, right? Like I said, a 1 week from now, I don't really care where the stock market is. I actually hope that it's lower. Like completely honestly, like I have a good bit of cash still sitting around. The best thing that could happen for anybody who's under 50 years old, I've been saying this on my channel, if you're under 50 years old and you have more income than you have expenses, you should want the stock market to go down, right? Unless you're, a day trader or swing trader who's trading it and you are bullish, like, okay, that's one thing. But I'm talking about like if you just have some extra income and you have a long-term horizon, my opinion, and certainly not financial advice, is these are discount moments. Now, if you're 50 years old or more, and you're nearing retirement, obviously, like a stock market crash is not ideal, right? Because you're at a different phase in your financial journey. It's just different. But for people who are under 50, which is the majority of my audience, stock market sell-offs are the best rebalancing act that we can see, especially for, everyday people, right? If you think about this, when the stock market is up and away, it favors, people who have already invested, who have assets, who are well off already. It benefits them. But when stock prices correct massively and people who have, cash on the sidelines, they can step in and they can actually be involved at better prices. And again, what we should, if you're under 50 years old, from a very long-term horizon, in my opinion, we should hope that the market keeps going down. Do I think it's going to keep going down? I do not. I think that the market is going to do very well in the coming years. I don't think we're going to have a 5-year bear market like everybody on Instagram seems to be screaming about, right? I think that this is an opportunity to accumulate shares for my own portfolio. And if it keeps going lower, great. I get better deals, better prices. Keep going down. I want it to go down, right? From a long-term perspective, that's the best thing we could get is cheaper shares for the long term. From a trade, and I'm separating this because from a trading perspective, There's also something to focus on here. Right now, the market's very fearful. That has been drastically benefiting gold price, right? Gold is, in my view, partially screaming higher because people hate this uncertainty and they want to move out of stocks and they want to go into gold. And that trend, that is a trade, right? That's a trade that I'm in. I'm playing that trade. It's not going to last forever. And like I said, in the short run, the stock market might keep crashing and fear might be remaining high. And I can just trail a stop on my trade on gold, but I'm not investing on gold up here. I'm trading gold long. I have a stop loss. I know what I'm going to do if this thing completely reverses. Let's say some great news comes out today and the stock market starts ripping, and maybe, some peace and stability comes back into the world and gold drops. Then I'll just take my profit and move on. And like I said, that is my positioning right now. I'm trading the short-term concern in market, but it's not just geopolitics. It's not just headlines, not just concern. That's really not why I'm in the gold long trade. It's really dollar weakness. So if we take a look at gold, right, getting a very bullish reading, retail is bearish on gold here seasonally, right? It's a bullish time. We talked about that yesterday. Seasonality looks good for gold. Trend is clearly to the upside. And we've had some economic data that is not super favorable to the dollar. In fact, I can show you guys, if we take a look at the US economic heat map, check this out. Got some new features here for you. You guys know we're dropping new stuff like hotcakes here. People are getting updates to their Edge Finder. It looks probably different every single day, and that's kind of fun. So we added some features here recently. First of all, we color coded latest data in orange. So if you have recent last 7 days, if something came in the last 7 days, it now populates in your Edge Finder as a yellow text item. Means that it came in recently. Now for the fun stuff. We recently, as of yesterday, have added the US dollar and stocks impact. And by the way, we will have all of these things up to speed for the remainder of our heat maps. Man, I'm so excited about this. I cannot tell you, I can't emphasize my excitement enough because I'm going to try and show you. Today in the chat, we had some really cool comments. And if this is you, if you're watching the stream right now, you're awesome. You made our team's day. Somebody just, we've had a lot of people saying like they're loving the new economic heat maps. Lock-in says just amazing. And I know I'm sugarcoating, buttering up our products, but genuinely, I do mean this. When people send us these kinds of messages like, hey, these tools are getting better, they're amazing. Genuinely, I mean it so sincerely. Like that motivates the heck out of me and the team because we love seeing that stuff. Like when people are benefiting from our tools, it just really, really goes a long way. But yeah, I put out this post. We're not building for tools for hedge funds. We're building tools for the people. And that is genuinely how I feel about it. I think that we're building some of the best stuff for the retail trader on the market. And it's only upwards from here. We're building some cool stuff, man. And again, I really appreciate the support we've gotten from a lot of positive comments, people who have been patient with us as we've been building these heat maps. We've been working on these just day in, day out, but they're coming along very nicely. So what this is showing you, let me just get to the US dollar impact stuff. So if I'm looking at the US dollar impact, right, of this recent data, most of these things are not looking great for the US dollar. But what about for stocks? They're not exactly evenly, right? So, or they're not exactly the same, right? So US impact, US dollar impact is not the same as the stock market impact always. Like for example, inflation data, right? Inflation data came in cool. That's not good for the dollar, but it's great for stocks, right? Cooling inflation is what the stock market wants to see. It means the Fed can cut rates. So that's not good for dollar, but it's great for stocks. And working with so many traders, we have, like I said, we have traders all over the world that have questions, that have concerns, that, use our tools. One of the big questions that we regularly get is, inflation, how does it impact stocks? How does it impact dollar? How does it impact gold? And we're trying to build tools and resources that will automatically showcase that to you and make it easier to understand for the average trader. So, like I said, overall, when people are saying like, oh, the stock market's going to crash, look, I don't see that, right? In the data, I'm not seeing that. We're getting overall a mixed view for stocks. It's a bearish view for the dollar, but we don't see massive, like if this was like 40%, or I'm sorry, if this was like 30% or 20% of these things are bullish, like most of these things are just straight up red for the stock market, then maybe it would be a little bit different. But you've got a lot of stuff holding up decently. Like recently, jobless claims came in slightly better than expected. JOLTS job openings came in better than expected. That's good for stocks. But also inflation this week was a win. Inflation was a win for stocks this week because you had cool inflation. Services PMI came in better than expected. And, that's the point. The point is, if you want to say we're on the brink of a recession, the data's not really showing that. Is it saying we're in a rock star perfect economy? No, but you just kind of have to say, look, we're somewhere in the middle. But what is the market trading like? The market's trading like we're going off of a bridge, right? That's what the market's saying. The data's not saying that, and that is where trading opportunities are born. Okay, up next, we've got our next session here with Kenzo. We've got Fundamental Fridays. We do this every single week. I'm sure him and I are going to discuss the heat map a little bit and talk about the state of stocks as things continue to fall. Gold continues to look solid. Dollar index a little bit lower here, but still kind of just sitting, holding at support. By the way, if you want to check out the EdgeMiner, we do offer trials for 30 days. If that's something that you're interested in, we'll drop a link in the chat here to where you can apply for that if you'd like to check it out. See if it's the right tool for you. Again, like I said, we've got traders all around the world using our stuff, and we are nonstop working to make this the best tool, the best resource for traders on the market who are looking to bring in the macro and fundamentals into their trading. So check it out. There's your trial link. You can apply there for that. And with that said, we'll be right back with Kenzo to talk more about what's happening in markets. If you're someone watching the show right now and you're outside of the US looking for a better brokerage, listen up. I wanted to take a moment to mention today's live stream supporter, Vantage. Vantage allows traders outside of the United States to trade CFDs. You can trade everything from commodities like gold, you can trade US indices or global indices, and you can even trade FX all under one brokerage, and you can connect to MetaTrader 4 and trade directly on tradingview.com. Not to mention, they also have a really good sign-up bonus going on right now. So we'll drop the link to that down below in the chat as well as in the description of this live stream. Check out Vantage. Now back to the show. All right, we're back with Kenzo. Hey, Kenzo, how you doing, man?
I'm doing great, thanks, and you?
Doing well. It's good to have you back on the show. Kenzo, stocks are bouncing. You've got NASDAQ up 1.5%, 1.1%. I know that on these sessions, we talk a lot about the dollar. We talk a lot about the indices. And I'm curious your thoughts. I mean, since we've last spoken, continued to see markets under pressure. Big slide here. The stock market, by the way, triggered at one point about a 10.5% pullback from peak to trough. That is for the S&P 500. The NASDAQ has seen a greater decline of at one point down 14%. Are we close to a low, Kenzo? Do you think we have the potential to start bouncing back, or is this not over?
Yeah, I think we are on the lowest areas comparing to the previous sell-offs. But I think there is still a room maybe for a continuation of that downtrend. But for now, yes, the market might try to reverse, but it's better to wait for the market to cross. You see, the last support that we have, or let's say now it's going to be the resistance. If we cross that red line, that yes, if we cross that, I can say, yeah, maybe it's promising that we might see the market going up because there are so much stuff going on. Plus, with the tariffs and other things, it seems like earnings seasons might be very bad for Mega 7 or for these big tech companies. So that can continue to sell off. But for now, I think, yeah, the market did breathe very nice. I think maybe it's time for it to bounce back, but there is still a lot to think about.
Kenzo, can I give you a quick pitch on why I think this market is due to go higher? Can I give you my couple things that I've been thinking about?
Yes, yes.
Just show this to you and to the audience. This is a little preview of my video I'm working on today. I know this is a little hard to read, but couple things that I think are actually quite bullish about this market right now. First of all, sentiment is extremely skewed in terms of the bears. So what I mean by that is that if we go over here and we just take a quick look at what the crowd is thinking, first of all, the put to call ratio just went parabolic. So everybody on the options market is buying puts. They're buying protection. They're buying insurance. They're terrified of where the market is going next. People are convinced the stock market's going to crash. That's what the crowd, that's what the herd is thinking right now. At the same time,
Yes.
take a look at the AAII Investor Sentiment Survey. This shows you what investors report on their kind of feelings about the market. And what we can see here is we hit for the first time, by the way, check this out, Kenzo. This is the first time that we've had 3 consecutive readings this extreme since 2008 in the financial crisis. That is how scared people are. People are reporting feeling very, very bearish on this market. So to me, sentiment is extremely, extremely one-sided. Everybody thinks the market's going to crash, at least the vast majority. At the same time, a lot of people think that the recession is in, that we're going to have a huge fallout in the economy. But the bond market is saying, no, 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 because the bond market is saying yields have not, in a recession, right? What happens in a recession? Yields plummet as the bond market says, oh my gosh, we've got a disaster. In 2018, people were seriously fearful of about a recession. And you see, that's what the bond market does in that time. Yields completely drop off of a cliff. So the other thing is that just going off of sentiment as well, the VIX has gone parabolic to the upside once more, showing that everybody, like I said, is pricing in, thinking that there's going to be huge volatility and huge drops to come. And then we had good inflation data this week. And then the last thing that I'll mention, and I want to hear your thoughts on all this, I know I'm throwing a lot at you, is that if we look at the economic heat map, which we talk about regularly together, most of these indicators, we added a new feature, the stocks impact feature or the US dollar impact feature. And then we summarized it at the bottom to keep it easier for our users. And what you can see here is that we have a mixed report for stocks. Now, that doesn't mean that the stock market has to go up or down. It was a mixed report means it's mixed. So if everybody thinks it's going to crash, but the data is actually kind of mixed for stocks, there's a divergence. So that's what I wanted to share with you. What are your thoughts on all that?
Yeah, I can say there is enough possibility for the market to reverse because I think when we have bad news in the market, let's say the tariffs and stuff like that, mostly the market will sell off. And on the news, it seems like to be a bad news, actually bad news because we already saw the sell-offs. But if we check it on the other side, it was necessary for the market to sell, and there is enough reasons to say the market might go up. If we checked previous, let's say 4 economic events that we received, mostly they were cooling off, which means inflation is not really as crazy as we thought, and which means we expect indices to perform very well with the lower inflation. And yeah, I think the panic is going to be there, but when we check events, fundamentals, everything supports that reversal. Because if we check the real reason why maybe we saw the sell-off, it's not like maybe there is a bigger company like maybe Nvidia not performing very well. It's just the panic from the tariffs, panic from other external things, which they don't really have. Actually, they have a direct impact, but it's not like 100% direct impact that can affect those mega companies. Yes, there will be price increase here and there, but the performance will still be there. And I think the business will just go as usual because tariffs now, it's just getting popular, but tariffs, they've been there for a very long time. So I think, yes, there is still that room. Now the market might still struggle around that level. There is that still a room to reverse, but I think it's better to wait a little bit.
For a technical perspective too, Kenzo, another thing that I've been watching is the 200-day moving average, which there it is. For the NASDAQ, for the S&P 500, we've lost some key technical levels. And to your point earlier about, the technical trend still looks pretty rough. Sellers kind of taking control of this market, at least for now. What I think we need to see from a trader's perspective would be a recapture of this area that you discussed here, but also a recapture of this 200-day moving average. That, to me, would give me more confidence that this is not a massive bear market push that's just not going to stop. I think actually, if you start to see some solid footing forming at these levels, things could look really good for the market. But like I said, I think everybody is convinced that the stock market's going to crash, that's going to go to zero. So we may have some bursts of downside movements. And I like what you said there too about, certain companies are poised to be in better situations than others. Like Amazon and Google, these companies are names that I've actually been adding to my portfolio pretty recently. So I'm adding some long-term positioning in stocks that I like in this sell-off. So very curious to see where that goes. What doesn't look so good, and what actually might be another helpful agent for all this, Kenzo, is the dollar index, which has been weak recently. We go back to the heat map for just a moment. You can actually see that very few things are bullish for the US dollar. We have a very low score here, which indicates a lot of bearishness. When we look at this list of things, most of this, especially this week with inflation data coming in very, very soft, giving us more bearish confirmation. It's the dollar index may, in my opinion, continue to be in a bearish trend for some time. Now, why that also is meaningful is that if the dollar continues to trend down and inflation continues to cool off, that could mean that the Fed does, in fact, cut interest rates, which ultimately could also be a bullish thing for stocks as well. What do you think on that?
Yes, I think you are 100% right there, because remember, the thing that makes maybe the market to go crazy, there might not really be the real effect on the markets, because like now when we say tariffs, we just cover everything. But if we check nicely, Trump, I think it's last year, he said actually the dollar is very strong and he wants to make it weaker. And I like the fact that on DXY we start to see that dollar is getting weaker, which means all those like inflation slowly they're going to go down. There were like government spending, reducing government spending, that will also deflate the dollar. So which means at the end of the day, we are going to see the rapid decrease on the inflation side. And that is actually a very good thing. It means we might have maybe some rate cuts going maybe around June or going up there, and which is good. The problem is when investors listen to the news, they don't really care what's really happening. As long as maybe it's a breaking news, we tend to use that information to everything. But actually, it doesn't really relate exactly to the stocks. Like now, when we say the Microsoft is selling, what's really going on? Is there anything bad? Actually, no. Everything's actually performing very well. But if we checked for the week, everything was just going down. Why? Because we have this ripple effect from this breaking news, tariffs, Russia, whatever. But when we check nice, everything is actually at the level where we can say it's time to buy. If you check those stocks, let's say Tesla, Microsoft, Apple, they are on the lowest areas, maybe 12 months lower, which means it's actually a good time for us to look for those. We buying at the discounted price. And mostly that's what investors want. Unfortunately, at the moment, it's like we are on the panic mode. But when we check, if we can leave the politics aside, I think everything looks good. We are supposed to look for those bullish moves.
Yeah, very, very interesting. And again, the other one we could mention is oil prices lower. Sorry for the chart delays here. I'm not sure what's going on. I don't know if it's me or if TradingView's got some weird delays in it right now, but having some issues loading certain charts. So I can still hear Kenzo and see Kenzo. So I imagine I don't think it's my internet, but anybody in the chat, is anybody seeing, anybody having issues with their TradingView, or is this just me? Okay, I think we're back. I think we're okay. Consumer sentiment just came in light, 57.9 compared to the forecast at 63.1. Previous was 64.7. So seeing some consistent drop here in the U of Michigan consumer sentiment reports, inflation expectations at 4.9%. So very interesting. We are seeing a little bit of concern come into the charts here. Taking a look at the S&P 500, Nasdaq blipped lower here. We'll see if they stay one way or the other. Dollar index not too changed here, and gold slightly positive on that data point. So here's one thing I will say about these sentiment things. Look, one thing that has been actually cited by the Fed is that a lot of times sentiment or reports of how consumers are feeling, while they are useful, oftentimes what people actually do and what they say they're feeling like is very different. So people might say like, "Oh no, I'm feeling awful," and then they'll go buy a new iPhone, right? Like it's interesting. People will sometimes say one thing and do a different, but it's still worth noting. And again, we see a cool consumer sentiment report initially causing a little bit of selling in the stock market, perhaps giving back some of those opening bell gains here. Any thoughts on that, Kinzo? Consumer sentiment? Does that do you ever think about or look at consumer sentiment?
Not really. I don't really. I do check them, but I don't really categorize them as like high impact news because mostly the people actually express the feeling according to the current situation. Mostly it's like last month. If maybe last month there were, let's say, floods or something, or maybe a higher number of, like, let's say, people were losing their jobs, mostly that creates panic, and mostly the sentiment is going to be obvious that, oh, things are going bad. 3 weeks later, things change, things are good. So you can't actually use that as a long-term gauge. I think you need maybe to check other things. On that, I don't really recommend that as a high impact. To me, I can say it's medium impact because it will change every month and it doesn't really help that much. But yes, we're going to still have some smaller moves or effects on the market, but the overall move won't actually change.
Yep, very, very well said. I think another one to look at too, another input to the economy, right? Like, there's a lot of fears about tariffs, a lot of fears about this, that, the other, and government spending being declined, and those are real things, right? Tariffs could seriously impact the state of the market. But one thing that we know right now, today, right? A lot of speculation about what tariffs might do, but what we know right now is oil prices are down. This helps the consumer. Gas prices at the pump going down is a positive input for the economy, right? The average person, when oil prices are up a lot and gas prices are spiking, that's painful for people. But we have seen, again, I'm not trying to get political with this, but to Trump's credit, there's some downsides, right? The stock market's been selling since his election, but let's also be fair and say that oil prices have dropped considerably since the inauguration on January 20th. Again, that's not to get political, but it is something to think about. People may be a little bit worried about the tariffs, but we also know a known is that we have lower gas prices right now. Now that could change, right? I'm not saying that lower. This is just a new paradigm, and we're never going to have high gas prices again. But right now, that's a positive thing for the consumer, right? Lower oil prices, lower gas prices. That's good. Could it be offset by a tariff down the line? Maybe. But we know right now that low gas prices are a positive thing for people.
No, that's 100%, man. And remember, Trump has a good relationship with, let's say, OPEC countries, those countries who actually produces, or let's say, yeah, produces oil. And actually, he's willing or he's trying to influence them to pump more. And that will actually make oil or Brent oil or crude oil to go a little bit lower, which is good for the world inflation, or every country actually likes that, because at the moment, once oil is going down, some other factors are actually affected in a positive way, and which is actually good. And it seems like it's struggling to go higher. I don't know if it's gonna go lower than that, but I think we might see it play around the same level. But that is actually a good thing.
Yeah, it is. I mean, it is. There's some interesting stuff floating around, man. I mean, there's one thing, this idea that the tariff, negotiations, the all that drama. There's an interesting philosophy that it is in, as you mentioned earlier, Trump's interest to get a weaker dollar, lower interest rates, and lower oil prices, and to point out, is the stock market down a lot? Yes, it is, right? The stock market's been tanking. But maybe this is when they talk about this concept of short-term pain for long-term gain. Maybe the idea here is that, okay, well, if tariff fears get the Fed to cut rates because they're, people get worried about what could happen with the economy, um,
Mm.
maybe that's ultimately part of the plan, is to lower interest rates, reduce government spending, lower oil prices, reduce the input costs to the consumer, and then the idea is maybe the economy will rip. Now, it's not a perfect plan, and there's a lot of economists who would disagree with that plan. The other thing that I would say, maybe the biggest problem with that idea, is that the Fed may not move to cut rates until they actually see cooling economic data, whereas the stock market is selling off because they're worried that economic data might cool next, right? There's a lot of people who are selling the fear of a recession, but maybe the Fed will not move so easily. Maybe Powell and friends will say, well, we're not going to cut rates until we actually start to see the economy weaken, until jobs data comes in soft. But one positive to that is that we got cool inflation this week.
Yes, I don't think maybe they will have any choice. I don't think Paul is gonna have any choice because inflation has been going down. The dollar has been actually losing that strength, and actually that is what they want, or let's say it's necessary for them to cut the rate. Yes, they might not cut immediately, but the tone that they might use, it will actually signal that maybe in the coming months or maybe along the way they will be cutting the rate. That one, I think, to me, just because they always say we will wait for the data. If the data allows us to cut, then we will cut. I don't think maybe they will actually go against that. And that, at the end of the day, I can say it's something that it's actually good, even though we can't just say it that much. But I think Trump, it's seriously pushing to that, even though some of the tariff stuff, which seems to be going to increase the prices. But for now, if we can say up to today, the dollar lost some serious strength, and that is not really bad. It's good for consumers. If the dollar loses the momentum, it's actually good. And it means the weaker the dollar, actually it creates affordability, because now slowly inflation is going to go down. When we say inflation, we just mean consumer prices or goods or items prices are going to go a little bit lower, even though other things they might still try to go up and there. But at the end of the day, that is the mission is to make sure that people afford some stuff, and if they can get that right, I think he's winning.
Yeah, no, it'll be interesting to see. I mean, there's a lot of speculation out there about what's happening. I do think that um, the stock market is kind of the very volatile, kicking and screaming child, whereas you take a look at the bond market, it's like super, kind of like, it's like the wise older. It's like the father or the mother or something, because the bond market is kind
Mm.
of like, I don't know if we see a recession, because the stock market's saying, oh my gosh, recession, it's happening right now. And you take a look at the bond market, and it's just like, the bond market is, we might see a little bit of slowdown, but it's not saying like recession would be like this. Like if we are going into a recession, the bond market would be confirming it, right? Bond market is actually bigger than the stock market. Many people don't know that, but the bond market is actually a bigger market than the stock market. And so,
Mm.
there's a lot of money flow in and out of the bond market. And what we see here recently is that if we take a look at TLT, this is bonds, 20 plus year treasury bonds, you can see they're going up. But if we were really going into a recession, you would see this, like we would see dramatic buying of bonds. And we just
Mm.
don't quite see that right now. So, I think that the bond market is kind of saying, I don't see a recession, and the stock market is freaking out over headlines. And I think there is a very important distinction there that we have to make is like, everywhere I look, I don't know if you've seen this, Kenzo, but everywhere I look on social media, it seems like everybody is so, terrified of a stock market crash right now.
Yeah, but I think whoever who is terrified, I can say they just follow the headlines or maybe let's say breaking news. That doesn't really reflect much because if you can take maybe a 12 months or let's say 2 years structure, maybe on
Mhm.
Nasdaq, we
Yep.
had those moves where the market reverses. There were no any bigger problem or anything, but the market one way or another, the market will end up reversing. Remember, when actually this is how investors think. If we think maybe this candidate or let's say president is
Hmm.
going to push the market to go higher, and at the current position we think maybe the market is already high, what we can do is we can cut our positions, or we can say we can rebalance our positions. By doing that, it means that we're taking out the profits. I think it was last month, Warren Buffett, he took some serious cash.
Yes.
Actually, is taking out because you know that maybe 3 months or 4 months, the market will be going up again. You rebalance your portfolio so that you can easily buy other things. Like now, if maybe anyone who sold above there, they can easily buy at the lower price.
Yeah.
So sometimes, unfortunately, there is breaking news, like the journalist who just asked Trump about the recession. He's not even she's, or I don't know if it's he or she, but they are not even some investors. They don't even invest. It's just a question, and the problem is the market is just waiting for the answer. If he said, yes, I think it's going to be like a recession, then the market will panic. If maybe they
Hmm.
say, I don't think it's going to be a recession, then the market will react accordingly. But that I think is just short term. But to me, I think the market has been going up for quite some time. Whether there is panic or not, along the way, we were supposed to have that sell.
Yeah, no, I think you've said it well, and I think the market is doing a little bit of selling now and asking questions later. I mean, when we look at this weekly chart, I think it actually adds some nice clarity to the bigger picture. Could we see another? I mean, 2022 was a pretty nasty sell-off for the Nasdaq. I mean, this was if you were long the Nasdaq peak to trough, you saw a decline of about 38%. That's a good drawdown. And the reason I
Mm,
bring that up is during this time, we saw almost 10% inflation, 9% inflation in the US, higher in other places. I think the UK saw 10 or 11% inflation. So we saw inflation very, very high. We saw the Fed hiking rates dramatically, and there were fears in that situation, which I think are much more valid, that we would see a recession, right? Um,
mm,
but we did not see a recession. In fact, there was an economic survey that was pretty famous for having a 100% probability of a recession that never happened. The market reversed course, inflation cooled
mm,
off, and we ripped higher. The point that I'm trying to get at is if you leave your politics at the door for a second and you just say human beings have a tendency to overreact and freak out and assume the worst things. It's in our
mm,
DNA to do that, right? If you're getting chased by a lion, right, you have to think about, like, if we go back, a million years or whatever, if you're getting chased by a lion, you've got to do something. You got to think of the worst case scenarios in order to survive. It's programmed in our brain of survival to look for the worst case
mm.
scenarios. But in markets, seeking out the worst case scenario and assuming that that's what's going to happen is one of the quickest ways to get absolutely destroyed in the stock market or the Forex market or any market. So the
Exactly.
point is,
Exactly.
you want to think with your brain, not with your emotions.
Exactly. No, you're right on that. You're right on that. So at the moment, I think it's all about emotions. It's not really reflecting anything on the companies that are in these indices. When I check all those companies, I don't really see anything bad with them. They were performing very well since last season. Now we're waiting for the fourth quarter of earnings, I think,
Mm-hmm.
because we're counting from 2024. So I think even if maybe the sales might be going down, I don't think they're gonna go down like as crazy as like maybe 2020. So which means it's just a smaller panic that we're supposed to have. But I like that because it's gonna give us enough chance to buy again. So to me, it's an opportunity. So I don't really think maybe that it's a problem.
Yeah, I mean, I typically, I tend to agree. Just for everyone's, knowledge, just because Kenzo and I think that there's not a certainty, but the difference is a lot of people are acting on their believed certainty that the market is going to crash, and what we're just saying is that maybe it does, but behaving that way, trading based off of the assumption that there's a guarantee it's going to crash, is a really dangerous way to think about markets. I would say that most likely this is kind of your garden variety sell-off, meaning it's just kind of a normal pullback in the longer term sense of things. Look, this is not a Great Depression sell-off. This is not a 2022 inflation panic sell-off, right? We don't see that data coming in. And I think that, regardless of your political biases and your emotions about what's happening, you want to be constructive. And in my opinion, as this thing goes down, I'll look to accumulate shares of stocks that I think have great long-term potential, even if in the short run things get uglier before they get better. So that's what we'll see. Amin says, be robotic when you trade. That is very true. And Charles says, I remember Nick's live in 2022, same conversation like this, recession fears. Yeah, everybody was terrified during that time. And the point is, a lot of times when everybody's scared, there's some good opportunities. Again, not guarantees, but potential opportunities. And historically, when everybody is scared, those are some of the best times to look at, long-term opportunities. Not a guarantee, but historically speaking, pretty good. So that's the important note, I think. Kenzo, I want to thank you for spending some time here with me today, talking fundamentals here on this Friday. Before we let you go, let me just remind everybody, if you enjoyed Kenzo's commentary and would like to find more of his work, he shares content throughout the week on his YouTube channel. There's some great free value that I would highly encourage you guys to check out. You can also find his Telegram channel. You can see all the different content that he's putting out to help traders for free. We'll drop the link here in the chat right now to get access to Kenzo's YouTube channel. Make sure to subscribe. You can also just search him up if you'd prefer. It's at Extra Hot Forex on YouTube. Kenzo, thank you very much for coming on.
Thank you very much, man, and also your viewers.
All right. Have a nice weekend, Kenzo. And again, guys, make sure to go check him out. Up next, we've got Chris Pulver joining the show. We're going to take a look at markets, and I want to spend just a few minutes chatting with him about what we see in this market environment so far in 2025. Very different than 2024. Before we take a quick break, let me just mention today is the last day for our 35% off discounts on memberships. If you're interested in getting access to my trade alerts that I send out, or Chris Pulver's trade alerts for that matter, all of it is 35% off right now. If you're interested in finding out more information, please take a second to send a direct message to our support team, and they can get you info on those memberships. You get access to, like I said, all the entries, all the exits, every position that we're taking. We trade a little bit of everything: FX, indices, commodities, options, a little bit of all of it. So if you're interested, check it out. Click the link in the chat to speak directly to our support team who's on the line and can help you to give you some information about that. Stay tuned. We'll be right back with Chris Pulver after this.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat and you can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show. What's happening, everybody? Happy Friday. Just typing up a couple of updates here. Quick winner on Intel.
Hey, Chris.
What's up, Nick?
I'm joining with you for a second because I wanted to see how you're holding up in this market.
That's exactly what it is. I'm holding up. It's fine. I mean, I'm still hanging in there. Today's a good P&L day, but watching carefully. Got a couple trades on this morning for SPX. Listened to some good podcast stuff last night, and just wanted to share a couple thoughts and views on things. So, technically speaking, we've had a decent flush to the downside. Everyone knows that. I don't know if the pain is necessarily over with. I still think that a sign of a potential bottom, not only technically of having this kind of fib from like high to low, but also looking at market breadth here, Nick. If you go to this little, where the heck is it? My little S&P above the 50-day moving average and the Qs above the 50-day moving average. They're somewhere in here. There it is. What? There it is. Okay, this one. So S&P stocks above the 50-day moving average. This was a pretty good and has been a pretty good timing indicator of market breadth offering up kind of a massive opportunity. It's not there yet. So if we see more pain to the downside, this would be something I'd be watching for a buying opportunity. We come back into, the lows in January. You look back here, timing this thing, Nick, when we had lows in what? October 2023, was that not the bottom?
Yeah, you're right.
Best time to buy after August, September pullback was October 2023.
So Chris, what you're looking at here is basically for the novices, the new people out there, the number of stocks or the ratio of stocks that are above or below their 50-day moving average created into an index on TradingView. You guys could grab that and add that to your watch list as well.
Yep.
But yeah, so when you're saying when that gets to an extreme low, when everything is kind of correlated, everything is selling off universally, you get that capitulation, that flush. That has actually been a good signal of potential reversals here. Is that what you're saying?
Yes. So, and just look at these levels. So this was January, and it wasn't, I wasn't overly bullish going into the first part of the year. We had that like kind of holiday roller coaster from Fed and then back up, and then the Santa rally failed. And early January, the market kind of picked up, but not really. But just look left and you find some better levels. If you bought anything back in October 2023, great timing on that. That was right after an August, September correction. And from October 2023 into all of pretty much 2024 until April, you had a pretty good surge. And obviously 2024 is still a pretty good bull market, climbing the wall worry. Before that, a nasty bear market through most of 2022. And you still had a June and an October window, which, June would have dealt with one more flush to the downside. But October, coming out of that Q3, Q4 transition in 2022, that was also what got us out of the bear market. Mag 7 led the way, tech started to lead the way, and it seems so long ago. The market's up 70+% since those lows. But look back even further, March 2020. What was that? The bottom in COVID. Okay, before that, 2019 Volmageddon after 2018 December's crash. So all I'm saying is, if there's more pain to the downside, Nick, this is a good indicator to have the courage to say, okay, I think I could still take a stab at the market and be rewarded for that. So that's
yeah, Chris, I wanted to ask you about that, just in general, about how you're seeing playing this market. And just to follow up, I asked you a little bit of how you're holding up. I mean, guys and girls out there, if you are anything near positive on the year right now, you are dramatically outperforming passive holding. I mean, I wanted to show you this. This is me so far here this year. I'm pretty much flat on the year, but it's in a context of, here's the NASDAQ, right? So NASDAQ is down about 9% with the bounce back here today. So I'm trying to hold up a bit, but this is the reason I brought this up is because prior to 2025, right, when everybody was getting just absolutely euphoric about, markets and Trump 2.0, and there was a period of time where on the show, Chris, you and I were talking about how it's reasonable to keep a cash position. It's reasonable to diversify. And listen, diversification absolutely stinks when the market's just going straight up. But then you're very thankful for it when something comes along like this, where we get the tariff trauma and the fears about what could this do and what could we go into a recession, all this. I just wanted to kind of reflect on that with you for a second about just the power of diversification options in your case, right, where you're selling premium, and this kind of environment gives you some potential great opportunities. I've been selling a lot of puts on stuff, but just wanted to get your thoughts on that. And if you feel, because it sounded like you're talking about looking to deploy a little bit more as this market gets uglier. What's your approach to this, and what's your thoughts on that diversification theory?
Yeah, well, trading through and diversifying through are the only way you're going to survive this. I
Mm-hmm.
do want to call out some big levels. Here's what concerns me. Okay, um, I think this administration, it kind of had way too much excitement going into the election bump and into
Mm-hmm.
the first part of the year, thinking that this is going to be just straight up tax cuts and straight up great for business. It's not. Like right now, this chainsaw in the federal government, this Doge agenda and tariffs and retaliations, it's like if this continues to escalate, it's going to force the Fed to possibly be what has to step in and kind of reassure the markets that, hey, the Fed's there to still be accommodative and dovish, maybe more monetary policy, because what people are looking past right now is I don't think Trump nor current investors realize how important the fiscal policy was the last 4 years.
Mm.
That's really what's been carrying a Fed that's been raising rates and pausing and being more restrictive on monetary policy in order to tame inflation. So point is, if the market's going to crash in, like, let's say on Trump's watch over the first like 6 months of his presidency, or whatever this year looks like, it does set the bar extremely low for, look what we did. Biden's administration was terrible. We had so much inflation, nobody's happy. I mean, he can get away with so many things to say how bad it was, even though the market's crashing right now on him. He doesn't have to take responsibility for it.
I've heard
But
that theory a lot.
if the
The
bar is
you
set
can
really low, then the fiscal side can come back in along with a dovish Fed, and they can fix it. Does that make sense? So we
Yeah.
could go from like a 10, 12% correction. And I don't think this is as bad as it gets. I mean, if you're seeing my chart here, my biggest concern, Nick, is that we're not done. And the best we're going to get right now is like a little relief rally towards maybe the 200 moving average, or maybe slightly higher. But we have a high low recovery and then another flush down. And that to me is an open space. And that open space opens up the doors for previous resistance back in 2021, 2022 when the market topped out. That's talking more like 20+% correction. And here's what I don't want to do. I don't want to be overextended in this window of uncertainty, because if we don't have a reasonable rally to kind of de-risk like I talked about this week, I need to make sure that I'm playing some heavy amounts of defense to the downside. So I hate to say it, but I'm not super bullish right now.
Mhm.
I'd be pleasantly surprised to see the market get back into sniffing out those all-time highs again, because it shows that the bulls have maybe grabbed the upper hand a little bit, as opposed to a dead cat bounce and the market flushes down and there's more pain ahead, because that pain
Yeah.
ahead of a 12, 13, 15% correction in the S&P could equal 20+% in the Qs. If we're in open space, there's no reason the SP can't be 20%. There's no reason the Qs can't be 25 to 30%. And we're having a very different conversation when not just are you surviving, but it's like, how's everybody doing? Are you, stopping trading? It's like, I'm going to trade through it. I'm going to diversify through it. But like I said, my biggest window right now is if I have the opportunity in the near term to de-risk, I'm going to de-risk. A lot of my trades are still
Yeah.
mechanical. They're all probability based anyway, but I don't want to see, stupid losses. I don't want to see like the pain trade of like, okay, man, you're up $3,000. Like I'm showing today, I'm up like 17 grand for the year. I was up $195,000 like 2 weeks ago,
Yep.
So I mean,
It can move fast, man. And that's the
yeah,
thing is I got to hop off here and run, but I just wanted to get your thoughts on that and see where you're at with it. But yeah, one thing you mentioned there, I agree with the 200-day moving average. If you get that pull back into it, let's see how market reacts to that 200-day. Is there
yep.
kind of this sell that immediately, or can we recapture that and trend higher? That 200-day is a decision point. When we took out that low and we closed below it, man, it's just been a flush since then. So 200-day, big psychological level for S&P and NASDAQ. But Chris, I got to run. Nice speaking with you. I got to jump on a podcast. But you've got the show from here. Guys, check out Chris Pulver, all of his stuff. It should be linked in the chat here in just a second. You guys can check them out. And you can also access the Pulver alerts if you're thinking about it. a1trading.com/pulver-alerts. You can see all the trades being shared in real time by Chris Pulver. So Chris, you got it from here, man. Nice
All right.
speaking with you.
Thanks, Nick. You too.
See ya.
All right. So I see Sammy's comment. Why wouldn't you close after being up? I did. I have been. I'm closing. Look, I trade 13 accounts. I've got a lot of open positions. There's a lot of open P&L. Option prices have to work out mechanically from start to finish sometimes. Sometimes I manage early. Sometimes I take it to expiration. So it's the open P&L of like trades and profits are up. So trades have to still work out, you know. So point is like that's just the P&L swings I've seen have been pretty extreme. But at least in the near term, it's like we're going to see what this market does. Today's reading in sentiment was pretty terrible. Not a huge surprise though. It's like this market continues to show bad vibes out there, and everyone's kind of priced in for the worst. But it's not priced in like the markets are not priced in for the worst, right? This is what's going to be important about how the Fed talks next week. As we come into the end of this month, I mean, I'm still wondering, like, I don't think there's a government shutdown right now. Government shutdown. So we have Senate works to avert partial government shutdown ahead of midnight. I mean, that's, again, they're probably going to pass it at the 11th hour. Maybe. Everyone's worried about Fed and federal government. Federal government jobs are like 2% of the total job market. But it's the attachment to that where federal jobs, okay, so if we have federal layoffs, and then it's the state and local, and then there's the contractors that are, working with the federal government. All these things I get it. Like if there is a pebble that's getting dropped into this pond, that pond has ripples, and Doge could be the little pebble that's starting the ripple, and it could just get worse and worse and worse. Clearly, when things get bad, it feels and gets bad fast. That is why the saying is bulls climb stairs and bears jump out of windows. This is fast, and this is not necessarily done. So I've talked about this all week. I think that you need to be aware of where this market could be going. Look, a bounce from here would be welcomed, not guaranteed. Nothing is guaranteed in trading. Like I said, when Nick was on with me, I mean, this open space would give me no confidence that we're going back to all-time highs anytime soon, right? So this flush coming back to April's low, August low, and we're pretty much right at it again. If this market bounces, good. There's at least a short-term rally. The pain trade has a little bit of breath for traders just to kind of recalibrate. I will be de-risking like crazy, which means some of my exposure, some of my trades that I mechanically put on with good intentions could be like break even, small losses, small winners. I will dump a lot of those and just get out, clean things up a little bit, and then be braced for, okay, more upside is easy and fine. More downside is what I have to be protecting for in trading. I've got to take a couple stabs. So I have been hedging this entire time. This has been a nice hedge that's played out pretty well. I put on another hedge out to August, another hedge out to December. If this market's not going to come anywhere near all-time highs, I have a trade that's risking about 1% for a potential 6% gain on a variety of strategies. So I'm putting about 1% total risk out for a potential of 6%, which again, market's down. Let's say the market's down from peak to trough is maybe 15 to 20%. If I can limit some of that exposure and also benefit from an asymmetry downside play, I will probably survive that 15 to 20% correction pretty well. And then I will be building back in, investing back in, knowing the probability of, okay, well, now we've got about a 23 to 25% to get back to these all-time highs when and if that happens. It may not be the case. Could it get worse? Could a 20% correction also be a major topping pattern that becomes another sell-off, right? Could we go into like a very ugly, sure, all this is happening, right? All this could happen. Is this all guaranteed? Of course not. I think that right now, there's still here's some of the benefits. Right now, there's about $1 to $1.5 trillion that's available for stock buybacks. You still have, like Mag 7 earnings were pretty solid. Consensus so far, decent. There's a little bit of, I'd say, cautious forward guidance on a lot of our earnings calls this quarter so far. Mag 7 still looking pretty strong. The whole AI race right now, I think nobody gives a crap about AI race because the market's dropping, right? CapEx spending and excess spending, like we're building for the future, all that's on pause right now. People want to know that, hey, is the market safe? And if it is, okay, what can I invest in? Because right now, tech is losing, right? Speculation is losing. Momentum stocks have dropped like crazy. It has essentially been flee to safety. That would be consumer staples. That would be defensives. That would be your diversifiers, your non-beta or your low beta, non-correlated assets. I think financials, healthcare, industrials, materials. If you've been diversified in gold and silver, those trades are doing really well. That's pretty much up, right? I that's actually my least favorite one. Escalator to elevator, they're the same speed. It's the same speed. So that's why I like climb stairs to jump out of windows because that's what it feels like. You know, elevators don't go fast. You know, if it was a broken elevator, then sure. Anyway, all right. I wanted to address so everybody's like just I know this chart's messy with some of the fibs and stuff, but you see my point. Like this previous all-time high, connect the lows from COVID. This is the one thing I'd be watching here as well. Like just I don't say this is the forecast. I would just think that if this happens, I need to be ready for it. This outer trend line that connects major lows in the market, COVID lows to the bear market end in 2022 into this correction also in 2023. Beautiful technicals on all three of those levels. And that previous resistance becomes support. I mean, I could see us getting there, right? I could see us getting there. So if we have high, low, de-risking, or even if this might be looked at as like a dead cat bounce, but there's so much structure in here. Let me zoom in. There's so much structure in here. I guess I'll throw the trend line on here so I have it. So right at those lows there. Okay. So if I zoom in, the one thing this little correction did take out is a lot of indecision lows. So this took out the election lows. This took out the post-election support. This took out all the holiday garbage. This took out the, divergent all-time highs. And so when this market rolled over, that did a lot of structural damage, in my opinion, at least for the near term. So that's why I'm saying, even if we pull back into this support level or this election gap area, that to me is about as good as it's going to get for a pullback. Look at your fibs, take your high, take your low, 23, 38, 50. I also have a 30% level. That's a really common, it's a gain retracement level. That's a really common thing for the market to pull back and find the 30 and then see how it reacts. A lot of times the 30% will get tested and then revisit the lows in this case with a swing low. If it's a swing high, you go, up, pull back to the 30 and then retest the high. Okay. If you got some Elliott wave peeps out there, that might be like where you're looking at some wave structure. Okay. Draw your capital letters and lowercase letters and Roman numerals and tell me that's the perfect chart. I never believe it, but anyway. Let's see here. So that's my point. If we have a little relief rally, that's great. What's going to get there? Well, the Fed could certainly come out with some more market-friendly language next week. They do have evidence that shows that the inflation data is improving. They are talking about still being restrictive. They could still be holding pace for maybe I don't know. I don't know what Jerome Powell is going to say next week, but explicitly, it could be mentioned that they're looking at considering cuts this year. I don't know if he's going to give us a number, but the market's anticipating right now about 3 cuts for 2025. They're likely not going to do anything in March. I don't think there's going to be some emergency cut. If my concern is if they did something stupid like that, I really think it'd be stupid to do an emergency cut. You're going to see the 10-year yield rip all over again and do the exact opposite. This is the first time in history where the Fed's monetary policy has created basically an inverse reaction to the yields, to bond yields. And so I just think that any emergency measures, it's going to do the same thing again. So I don't know. My concern is that we talked about this 10-year for a lot. I said this is an important chart to watch for this year. Is this a little slow correction for more dropping in the 10-year? This to me comes with a recession. If we're talking like, things getting worse, things getting more dire, the market's bottoming out further or going further down, then the 10-year probably falls with it. We might see the 10-year stay relatively sticky in here, but we're not at highs. We're not at lows. This is just, it's okay. It's okay. It doesn't hurt. It's not too much pain. It's annoying, right? But it's not causing, this like, this breaks the market, or this is now the market's in a recession type thing. Does that make sense? So the 10-year just kind of staying where it is fine for now. I don't know how it's going to react with the Fed next week, but it's been relatively calm since we kind of had most of this was dropping with the market. And so if we have another leg lower, I could see another leg lower here in the 10-year as well. So we'll figure it out. But technically, it's not like I'm looking at this from a technical perspective and saying like, oh, this is something I totally want to trade. I'm not trading it. I mean, I would be happy to see that if we stay where we are, life doesn't have to change and be extreme, right? There's nothing crazy. It's like, well, mortgages are more expensive, but they're not as high as they were. Refinancing is a little bit better than what it was, but it's not great. Like, this could be that stagflation window that everyone's been concerned about, is that we have earnings compression, we have slower growth, and that the 10-year just kind of stays stuck in the middle, and you just got to figure it out. It's going to be a bit more of a grind. It's going to be more of a struggle, but it may not really cause any major pain, where a recession would be great for, we'd have a whole new idea of like, we can reservice debt, because the market's tanking, and that's not a good thing. But to the opposite effect would be, if and when the 10-year goes higher, that ultimately that 5% level is a key level that just has found ways to break the market in the past. So, I'm legitimately concerned up here if the yields go higher. And we'll see how the bond market behaves. But this is like Ray Dalio stuff with the change in world order. This is debt. This would be your debt bubble, right? This would be your debt issue. This would be your debt issuing. This would be the debt bomb would be the concern up here. Okay, down here, you're talking more recession. And this whole idea right now is kind of like the federal government, current administration. I think that the Fed has the eye on the prize. The current administration is almost like they have a blinder type agenda, and it's just playing hardball right now. And we don't know the extremes. We don't know how bad the retaliation is going to be, but it certainly has everyone's attention. It's all everyone's talking about. I mean, if you go to Google Trends, I'm pretty sure tariffs is probably up there, which is annoying. I know, in what I do for my line of work, I usually don't have clients that bother me, because I just continue to trade, and they don't need to know how the clock tells time or how the sausage is made. But the reality is, when they contact me and just say, "Hey, this tariff stuff. Hey, Trump. Hey, the markets. Hey," like, that just shows me that media is so pervasive and so consistent that message is now everywhere. That's also a contrarian indicator for me. Same thing with the AAII sentiment being this bearish. Same thing with the fear and greed index being this fearful. When I have my clients reach out, it's the same thing. Now, it doesn't mean that I'm a contrarian and I never listen to them. It's like, obviously, I'm attentive, and it's just like, look, we're going to trade through it. We're diversified. We have some hedges. I'm playing the downside. I'm looking to see, look, this market may drop 20%. I can see that, technically speaking. We'll be able to trade through it. We're still on 30+% cash. We'll be fine. And that's the reality. That's always the reality. But when we start to see these levels, it's like there's positioning that happens here, and there's positioning that happens here, right? The market can just kind of operate normally, whatever that looks like, which is typically up, right? Positive drift. This market likes to have bull markets that get extended for a while, but extremes can get a little weird. Extreme greed, protect your profits. Extreme fear, I do look for opportunities, but I'm also not going to be overextending and being crazy risk on. Not yet. I think there's still way more potential uncertainty and pain ahead. And on top of that, we've also seen a very persistent VIX. Okay. Yes, the VIX is retreating. Okay. Which is honestly a good sign. However, this is one thing I looked at this morning. This is a bit of a concern. This is the VIX term structure. And what this shows is that your forward looking months are still looking at, let's see here. This is higher volatility to lower, to lower, to lower. So we are in this phase, and there's always like silly terms here, but backwardation is when this is going lower, which means Right now, volatility premiums are so high versus going out another month and another month and another month. So this only happens about 16% of the time, but it does wreak havoc on the markets when it happens. Okay. So until this settles into this type of slope, which is what usually you see in a instrument like this is called contango, this is where things can get a little bit uncertain. Okay. And the market's still anticipating that there might be more uncertainty ahead, because until this is flatter, until this is starting to slope upwards, this market is not over the idea that short-term volatility is at a much higher premium than longer-term volatility. And that's usually the opposite, right? You'd think that, do I know better now than I do in a month? And right now it's like nobody knows now. That's why it's so much higher. But in a month or two or three, it's like this premium is priced lower. Okay. So point is, I mean, this is what I'm talking about. Okay, watching that market breadth indicator with the how many stocks are above the 50-day moving average on the Nasdaq and the S&P. That's an important level. Look at some timing. When I see the volatility indexes in backwardation, that's not showing that the pain is done yet, at least in the near term. So I'm happy to see the VIX is retreating. It is a mean reverting instrument. This is good. Okay. What would be even lovelier would be to see that this continues to go lower. And even if we have elevated volatility from, 15 to 20, I mean, this got up to 29. But if we're talking about this thing greater than 30, if VIX is greater than 30, that has been painful market movement, right? The last time we were above 30, outside of our outliers we had last year, which even the December 18th FOMC was not above 30. We just had one of the single day spikes, just like we did back in August 5th. This was a very scary couple of days, right? We jumped from 18 up into the 20s into the 30s, and that kind of one-off outlier spike was a little bit wild. But point is, actually, real quick, I'm going to cancel. I've got a call side trade here. I'm going to cancel. Give me a second. Pending order on the call side 57. It's probably going to be all right. It's fine. I'll leave it for right now. I just had some profit on it for SPX. I've got this trade running for a 65-cent broke wing butterfly. Anyway, let me finish my thoughts here. So outlier for the VIX on August 5th. Outlier one-day movement for the December 18th Fed, but not really doing any major damage. Before this, let's say you just say, okay, one-off event, single day one-off event. Look at where we are right here. This recent top just below 30 on the VIX, 29.74. You got to go all the way back to where? March of 2023. What happened? Well, let's see what March 2023 did. Because to my knowledge, March 2023 doesn't really come to mind as like, oh yeah, I remember March 2023. Okay, but let's see what it did. March 2023 was where are we at? Yeah, okay, there you go. So there we go. We came out of the this was a pullback. Makes sense. So we came out of the bear market, and March 2023 was a retest of that trend line, right? Resistance, resistance, resistance. We break above it here. This is at the beginning of the year with that nice little Q4 rally. But look at March 2023. Connect the dots right there. And here is your, we've got the S&P around 4,200, pulls back to 3,800. So about a 400-point drop. That is your February to March. What'd that do on the VIX? That was a spike up to the same levels we've seen with these recent highs. Okay, you're going all the way back to that little pullback, which was a 400-point drop. Okay, and it's not points to me that matter anymore. Points don't matter, right? If you're like, oh my God, the S&P dropped, the SPX dropped 200 points today. Points, it's percentages. Percentage. That way it's relevant. Like 10 years ago, the Dow was not 40,000. The NASDAQ's not 20,000. It's like percentages. It's still the same market. It's just percentages. But we had a pullback, and we had a percentage pullback. And that was the last time that we had seen the VIX spike up that high outside of December 18th, August 5th, March of 2023. And before that, it was you're literally talking about a bear market. Okay. So this persistent volatility we've seen this year has also put the VIX into areas of like, you're paying attention, right? Decent pullback, but resulted in a bullish move. Like 2023 was a very nice bull market, but yes, we had a pullback in March. Okay. But before that, you were in the 30s through most of 2022 with these wild swings of 15 to 72% down, and then an 8 to 10% rally, another 10 to 15% down, and another rally. I mean, this continued to happen until it was finally done. But that was also just think like 2022 is so different to right now. And I don't know if it's better or worse, but I do know that the Fed was raising rates, and the deleveraging that was happening in the markets is possibly the same thing we're seeing right now. If there is a reason to get out of momentum, get out of growth, get out of speculation, it's a good time to do it. And that's where a lot of this is. And on top of that, the other thing that is a big exit in 2025 has been, I think everyone realizes that Mag 7 at 30+% of the stock market, your whatever they're calling it, the fateful 8, the top 10, whatever the heck you want to call it now, those trillion-dollar companies that have led us through the last decade of gains, that led us out of the bear market in 2022, that led us through most of 2023 and 2024, that deleveraging or that moving from, look, my Mag 7 exposure has made me X amount of percentages, it's just rebalancing. And when you're exiting that at such a large market cap, we said this right here, this single instrument, MAGs, has been a big reason the market's dragged down as well, right? Every one of these stocks in the Mag 7, or if you put Broadcom in there for AVGO, you've got 8 stocks. You put Berkshire in there, you're at 10, right? 9 or 10. But this correction, so MAGs all by itself went down 22%. Okay, well, what did that do to the indexes? S&P dropped over 10%, NASDAQ dropped 13+%, almost 14%. 7 stocks. That's insane. So this is an important way for the market to broaden out. And I did say this within the last couple of months multiple times. Everyone thinks that the market can broaden out by going up and broadening out. But the reality is most of the time this market broadens out when it's going down, because what's been performing really well starts to get exited aggressively, and then that money is going into cheaper things. And the other issue with the U.S. markets this year is that the U.S. has been, you're calling it American exceptionalism or U.S. exceptionalism, because it's been one of the best performing markets in the globe for the last 2 years running. Or you look at the last decade, the U.S. markets have just crushed everybody. Okay. And this year, what's leading the way? China's had a big rip. Europe's had a big rip. Argentina last year. I mean, these aren't like all major, like monster competitors, but Europe's a big market. Japan's a big market. China's a big market. And the U.S. is, I'm thinking we're going to stick in there. I don't think the U.S. is just like, the U.S. is dead in the water, just invest in international stocks. I'm not doing that. The liquidity that I have in U.S. markets is way better than going international. I have a couple of instruments that I'd even be watching. Like my China basket's maybe 4 to 6 stocks. My Euro basket is Barclays Bank and maybe trading the DAX. I don't trade the FTSE 100, but maybe. It's like few and far between of what I can trade or want to trade. Point is, the market's rewarding beat up indexes and beat up countries and things that can outperform the US, at least in the near term. But what hopefully is the case is that the US stabilizes, has some resiliency, and the global economy as a whole can get stronger, as opposed to the US is down in a recession. Our market's big enough, it's going to drag. It'll drag Europe down. It'll drag China down. It's like, I don't think they will just survive all by themselves. Sure, we could have a one-off year where the US is down and everything else is up. But if you look at an overall global economy slowdown, that's not going to be a good thing. So, like I said earlier, I don't know what Trump's agenda is. I do think that he has all the excuses in the world to let this market tank on his watch, potentially crash on his watch, sour sentiment, ruin everything that looks like this momentum's been up for the last couple of years, but yet say, it's not my fault. This needed to be done. This is the pain we have to deal with. We're going to build it. We're going to build it back, and it's going to be better. It's going to be the greatest thing you've ever seen. Hyperbole, superlatives, all the BS he says. But if you're prepared for that, there could be a lot of opportunity ahead. I don't know how stupid this situation gets. We never know, but I want to be braced just in case. If this market is not a little correction, okay, I mean, where would I get more bullish? Where am I more convinced that it's more bullish? Well, if we take out these highs, right? So this would have to be like if we're greater than, let's say, 6,000. If we're greater than 6,000 the SPX and we can hold above there, then this market might, in fact, find a way to revisit highs. Might, okay? But if we are not there, and this market is a little dead cat bounce, just the 200 moving average and another flush lower, if that's not going to give us a bullish pattern here, then this is where things get really messy. That's where this feeling is going to be the pain trade. Like that's going to be the capitulation that nobody wants to experience. And most people don't hedge enough to make any money when that happens anyway. I will be hedged in order to, offset or try to offset a lot of that pain. But any type of de-risking I can do in here is going to be my main focus over the next probably 2 to 4 weeks. Make sense? All right. So that's where I'm at. I mean, that's the whole portfolio right now. That's everything that's going through my head. Um, that's it. Like, there's a lot to prepare for. There's a lot of uncertainty ahead. I think in the near term, technically, the market's due for a bit of a bounce. We have every major, relative strength index sitting at lows. I'm looking for some type of divergence at the bottoms. We're not quite there yet with that market breadth indicator still having more to go. But it would make sense to me, at least in the near term. We've gotten through CPI data, PPI data. They actually were improvements, so that's encouraging. The Fed next week, I almost, the Fed has been like this hated entity for the last couple of years because they're not accommodative enough, and everyone's looking at what everything is saying. But look, now you got a president that wants to be seen and heard every day. So the Fed could potentially be this like wiser backstop to say, look, we understand the uncertainty with tariffs and we're not sure where this goes. It's not our job to be in the political game, but they are going to be monitoring all this stuff carefully. I mean, if the Fed starts to say we're going to be willing to be more accommodative, then maybe the market, likes that a little bit. I don't know. I mean, I think next week that's one of the only major catalysts that we have to kind of wrap up the month. We go through the 21st, the 28th, and the 31st is going to wrap up this quarter. Right now, it's like the quarter's down. I mean, if you look at the month so far, actually, screw it. The first year, this would be your quarterly candle. Okay, so for your 3-month candle that starts in January, right now we have a negative quarter. And from the open, this quarter is down right now around 5%. So for the quarter, the S&P is down 5%. With a long wick high, a long wick low, like that's where you're getting that big like 10+% correction because of that all-time high. But for the net quarter, market's down about 5%. How about the Qs right now? The Qs also red for the quarter with a large volatility spike from the upside to downside. Let me see if I can zoom in a little bit more. Yeah, the wick stop's about right there, but we're still down for the quarter. So where we started to where we're currently sitting, down about 7.25% for the NASDAQ. So yeah. All right, I'm going to cancel this call fly and just keep the bull side running. Okay. So right now, markets are getting a little bit more exciting. To the upside is good. Gap higher, little retest, heading to fresh highs is always encouraging. I'm kind of loving this level here at 56.60. If we get a big old rip to the upside, a nice little recovery, let's see what the SPY is going to show us. Fresh highs. I've got some levels filling up here. This is good. Getting into some open space. I mean, I'd like to see it holding above this level. If we hold above this level, there's room to drift and have a nice recovery. I mean, it's this. So, and again, I don't know what's going to happen, but if we drift higher, we take out or test these recent highs around 561, 562 on the SPY. I don't see any major levels. This gets kind of 560 was a big point today. But man, I wouldn't mind seeing the market get a little bit of a run and try to get back above. Let's go to the 60-minute chart here. Okay. If we can get back above this chop fest here, get back above this high. Now we're talking, this was last Friday's low. So if we can clear these highs, use some straight lines here. If we can clear this chop, get above Friday's low, now we're talking about a, trend line area that might offer some levels, previous support in here as well. But it's pretty straightforward. Just look at the fib, right? You go, let me put a fib on here for a sec. Fib is somewhere. There it is. There. Simple fib. So outer trend line level, if we can clear that Friday low, get above this recent chop, pullbacks, this is a 38% zone. So 573. Okay. So like I said, I'm still, the 23% might still act as a near-term resistance level, but if we can clear the 23%, get through the 30, 38 is logical. I could see the market struggling a little bit there. If we get to the 30 to 50%, awesome. That would be like a perfect de-risking window for me. And I've got some short-term trades that I have been in. So I've got some short-term trades down here that will also be proven to be nicely profitable. So far, so good. I've got some, I mean, it's a pretty good P&L swing on the day, up 81,000 brings me to 40K for the year. And I just continue to trade through it. It's like I deal with the ups and downs. It's been annoying to see red for the last couple of days. But I'll just fight through it and figure it out. Pretty big P&L swings. One of my services, yeah, it's been a pretty big improvement on the day. So 561 is an important line. I'm watching this one. This is out to April 4th, March 31st. This one should be fine. 1, 2, 3, 4. Right now, just need this thing to settle in for next week. This is the big one, 560. Same thing here. Want this one to settle in for the week. 550, 535. This one's a bull put spread. That's fine. Actually, that's a credit spread. And then 560 for April 11th. So I'd like to see a little bit of a short-term recovery. Hopefully we time it pretty well. All right. What else? Let's go back to the daily. I saw some requests, Bitcoin, dollar, yen, stuff like that. That's cool. Let's do it. I've got a few more minutes here. Let me make sure I'm not overlapping any schedule stuff today. Okay, I'm good. All right. I'll go for a little bit longer. Keep that fib on here. Go to my 5-minute. Yeah, good. Okay. So if we can stay above this 560 handle, drift up into these previous levels, I'd love to see this market getting back to like 561, 562, and just show that for next week, any type of traction, the upside is a little short-term relief, which is not a bad thing. So, markets are showing some green today, which is nice. SPX up around 1.66, NDX up around 2%. Dow's up around 1.25. Russell's up about 2%. Volatility index down quite a bit. That's a nice little retreat from the nearly $30 level. So 29.65 back down to 22. That's good. If the VIX continues to fade and revert, that's good. Okay, dollar index. I don't know. I don't like this area. I'm more interested in dollar index support. I'd mentioned this week. If we have a near-term pullback, these are very inefficient candles, by the way. So we'll pull back into this window. Looks pretty good to see another chance to short the dollar with a, pretty common stop loss. Like just put it above a U-turn. Let the market pull back, give you some confirmation. Stop loss above the trend line. That would offer up hopefully some reward to risk that's greater, right? As far as buying the dollar, that's where I would consider dollar cost averaging in, or I'd mentioned this week somewhere in here, where we had this initial breakout in September, October last year. So if you want to start getting into the dollar early, I could see that being a bounce or that being a bounce and just building back into this inefficiency. So if we don't have a pullback and this is just down and then down a little bit more, look for some oversold conditions with some divergence, and I think the dollar pops back up into that window. So there could be some dollar strength coming, soon, but I'll repeat this. If we pull back first, I look for another sell trade on the dollar. If we continue to drift lower and what goes up does come down, and it does so in the same kind of inefficient manner, if this just continues to slide, then building a support case for the dollar to come back and find the middle, right? This is our high, this is our low, market comes back to the middle. That's a pretty easy trade as well. So we could have some fluctuations in the currency markets with that. Oil, not touching it. It's at the lows. I think these lows are vulnerable. I don't know if they're going to break. They might not. I don't care. I'm not trading oil. Natural gas, I am in. We are retreating off the highs. I'll just continue to sell. This is a diagonal spread that I have. Gold, 29.85. I did put a trade on gold, and I posted this in Pulver Alerts. I'm essentially somebody messaged me in the chat and they're like, so are you bullish on gold? And I'm like, well, I mean, yes, because I have GLD and I've got GC futures long, but I'm not bullish on this particular trade. So what I did on gold is I used GC, and here's my position. Must have been another workspace here. Give me a second. Was it this guy? Nope. Let me find the workspace. Maybe it was this one. Yeah, this is it. Okay. This is a workspace that I put on yesterday. So we have overbought conditions with divergence on the daily time frame that just connected this recent high. Okay. On the weekly chart, we have overbought conditions with divergence sitting at this new high. We have nothing but demand levels to the downside. We also have a very high overextended 200-day moving average. So in the near term, I am looking for a correction. Does that mean that I'm aggressively bearish on gold? No. So the trade that I took is I'm still running long shares of GLD. I'm still long with GC futures. But what I took yesterday was this trade. It looks something like this. This is current price, and I've got all this space, and I collected $1.20 credit on the trade. And if price gets to 30.85, it starts to give me a ramp up in profit, and that goes all the way up to 32.50. And above 32.50, I have risk. So I have $1.20 profit that potentially becomes another $500 on top of that. So I could max out here from around 30.90 all the way to 32.45. I could max out at a $620 winner. So I'm still giving gold a chance to go up, and I could still profit from that with a high probability. It's about a 90% chance of profit on the trade. But if gold goes down from here, then I'm just going to keep the $1.20, and that's my winner. So part of this is because we hit a fresh high and there's lots of divergence and we are stretched away about 13%. Now, historically, that's pretty high. We don't see a lot of times where this is above 14, 15% of distance away from the 200 moving average. So this stretch away right here is around 12.5%. So I looked back at this high here, and it's around the same. This high here to the 200 moving average is around 13, almost 14%. This high here, same type of thing. Started to see that the market responds to that. This was about 15, 16%. Market responded by what? Going sideways for months, right? Market responded here by pulling back. Last time we had this big move above, that's really not that far away. This one, maybe about 12%. Other than that, I mean, this is probably the last really big stretch away move, and I think it was still like maybe 15 to 16%. That was about 18 to 19%. So the trade that I built and put in for gold futures is the market could go up about 23% before I take on any risk. So I think I've got a good trade. Obviously, if the market responds with a correction or any type of pause, this is just an easier trade for that $1.20 credit. Okay. All right, so that's trade on gold. What else? GLD still running shares, expecting a correction. It's fine. You know, own shares, have some credit spreads. I still like gold. Awesome. You know, and right here, it's like right at that 3,000 level on XAU. It was like pretty much tick for tick. So the paper trading GLD, it's been a nice little spot trade along with XAU running higher. Silver making some fresh highs. Sweet. Silver's also not above recent highs. I'd love to see silver again outperform gold in the near term. I have shares of SLV. I've got some diagonal spreads, and I'm hoping that we'll continue to head higher. SI futures, same thing. So just a couple ways to have some exposure. Bitcoin up a little bit off the lows. We've got a 76.6 low, currently trading back up to around 84. IBIT is up to $48. MicroStrategy back up towards 283. Again, you know, is this an opportunity to see prices head back up? Yes, no, maybe. I don't know. This whole idea of like the U.S. having a crypto reserve is not what everyone wanted. Reason why is because they're not adding anything to it. They're not actually buying Bitcoin. What they're doing is they're just doing any seizures and forfeitures and confiscations are just going into basically a digital ledger for the U.S. But they're not buying anything. I don't know, but there's still, I mean, there's still resiliency to Bitcoin. I think that this is a key level. I think for MicroStrategy's sake and Michael Saylor's sake, that if Bitcoin can hold above this like 74 to 70K window, then he won't look like an idiot. But if Bitcoin starts to, I guess this would be my concern on Bitcoin. Technically speaking, if Bitcoin were to take out these lows, okay, to me, this looks like a very damaging and dangerous profit pattern. Like that looks like a terrible bear pattern. So I think it is critical for Bitcoin enthusiasts out there to see that technically this market is still willing to hold this type of structure. Because if it doesn't, my concern is that this great run to $108,000 is going to end miserably, and all of a sudden we're back to where we started. And that little inefficiency there, and that little inefficiency there, and all these levels get filled and found, and that's going to suck, right? That being said, however, could I trade options? Sure. Well, I can short the heck out of MicroStrategy and short it to zero. I can short IBIT and BITO, and I can short FBT. I can short all of them. So there's ways to trade it. Obviously, you can trade the Bitcoin, you know, Bitcoin versus dollar, but whatever, you can spot trade it as well. But again, I don't say it's really damaging until we're back down to these consolidation lows. Otherwise, if we hang in there where this resistance becomes support, that's probably a good thing to kind of hang in there, not do too much damage, and then see the bulls get on the right side of this trend line, and then we're looking for a recovery. So that probably is best case scenario for Bitcoin bulls right now, is that we don't do too much damage. Certainly, it'd be really nasty if we came back down below 50 grand. If we came back to that level, I would be like, okay, I think the party is over. You know, and it might come back to like 30, 20K from there and then build all the way back up. And oh my God, look at that. Bitcoin's the best thing ever. Right. But, you know, people are stuck holding the bag at 100 grand, thinking it's going to 150, thinking it's going to 200, thinking it's going to a million. But also, this is what Bitcoin traders have dealt with for a, you know, a decade plus, which is ridiculous drawdowns, right? That would be a 70+% drawdown. I've seen it in the past. I watched it go from 20,000 to 3,000. Right. And then I watched it go from 3,000 to 20,000, pulled back, went back up to 60 to 64,000, pulled back into the 20s and the teens again. I've seen it. So time will tell. All right. What else? Copper. I'm in nearly full profit on this trade. I could just protect it. I'm just going to let it go. It's you know, way out of the money, high probability profit there, which is good. Japanese yen making some slightly higher highs in Japanese yen futures. I'm still holding FXY long. The DAX looking a little bit better. I think a little pause is fine. This is another one that's really far away from the 200 moving average. It's not a bar count necessarily, but we're really far away from it, where I think a little consolidation. I think bull flag could be good. I think DAX might be one of the best assets / indexes to trade this year. It's already had a great start. So now I'm looking at it more from the technical side of, we have a great start. If there's a bull flag here, man, that could be a good one. And part of that's just because you finally have some fiscal policy going into Germany. You finally have some fiscal policy going into the Eurozone for the first time in a while. It has been usually one of the tightest, government spending zones in the world, like the most restrictive. And now they're kind of loosening the belts a little bit. I think that's a good thing. So I think this looks good on any type of pullbacks. I'm hoping we have some dynamic support. Otherwise, even a bull flag is not a terrible spot. So I have some exposure on FEZ. It's cheap enough. I might just throw a bit more at it. But yeah, I'd like to see if we just pull back into like maybe the 50s and I'll throw something at it. Argentina bounced a little bit. China is still creeping up towards these fresh highs. I've measured this move on HSI up to around 25,600. Mags, if we get a pullback, this is one thing I'm watching closely as well. Can the Mag 7 get us back above the 200 moving average? If it does, well, we've got a pretty nice flush here. So we have high, low, lower, high, lower, low. Okay. So if this pulls back to the 200 moving average or slightly above that, I mean, this is good for a de-risking environment. The concern, of course, is that this ends up getting pushed lower. If there's more getting out of Mag 7, but I'm gonna try to find this for next week. If you look at price to earnings on Mag 7 versus price to earnings with the entire S&P minus Mag 7, the valuations have come down quite a bit. Like basically, everyone's been talking about, oh, the S&P is overvalued. The price to earnings ratio is like 24, 25, 26. Well, if you exclude Mag 7, the S&P is at like a 17 price to earnings, which is around historical averages. So what really ended up happening was your Mag 7 price to earnings was in the 30s and the rest of the market was in like the teens. So now that the Mag 7 has corrected, it's actually, this is the market broadening out. Okay. So interesting development, but I'm just curious, like, do people absolutely hate Mag 7? Because I don't think it's bad. I mean, I think if you get a chance to buy, Amazon on sale for 21%, and this is one of the world's largest retailers between Walmart, Costco, Amazon, also even through a pullback, even through a drawdown, staples and consumption, basic needs and necessities, Amazon has everything you need, like scary convenient, right? Delivered to your door within same day or 1 to 2 days. It has overtaken Walmart for global revenues. So it's on sale, but is it a good environment? Well, that remains to be seen. Because if I would say this, Amazon's not going to all-time highs if the market's not going higher. I mean, Amazon is not just by itself can be like, Amazon is amazing, while the broader market's like, yeah, we're down 15% in the S&P, we're down 20% in the S&P. There's no way it goes higher. So that is the only downside. Is this doesn't mean as much as this is fair valued and on sale, does not mean that we can't go lower. So I believe I closed out. I think I have a ratio spread on Amazon. Let me double check that here. Amazon. Yep. So I'm out to May and December now. I closed out a winner on Amazon. Let's see, Intel. Yep. So I closed out a winner on Amazon. That was a ratio spread. And now the expirations are out a little bit further. So that one's fine. This trade is done. Took the profit there. I still have shares of Amazon that I've rolled, and now the covered call is looking better. The roll is out to August at 225. My puts, I bought like some 165s, 160s. They were part of my collar trade. They were out of the money. They did see some profit here, but I just want to keep them in case it's got way worse. And I'm still going to keep them. I might just end up re-upping on the small debit for the long puts and continue to have some type of downside protection. But I still own the shares. I like where it is, and I will continue to actually, I might, I don't know. I was gonna say I might fill in some of the gaps here and look at another trade on Amazon because I don't have any, really near-term expirations. I have, I think, May and December now. So I have May and December. So if I wanted to consider maybe this, I don't know, maybe. I like Amazon enough to say I'd be willing to own it. I could go out to, June, July. I think July would be fine. I mean, if we're going to have seasonal rally, through the summer months, if the market's going up, but part of me just, I don't know. I don't know if this market is going to go up for the first half of the year, or if this is like Trump's window to say, look, let's crash the market. I'm not saying this is happening, but if the market is willing to say whatever's happening is all this uncertainty and the market's going to crash for all these, like the myriad of reasons it would crash, right? But after the cleansing, if you will, after the corrections, it gives the administration a chance to build something over the next 1.5 years before midterms to say that they fixed everything, everything that needed to be gutted has been gutted, everything needed to be reformed is reformed. Now we can build a stronger economy, blah, blah, blah. But it's not without all the pain that comes with it. So my point is, I don't want to start throwing a bunch of trades out here if the market's going to flush down another 5 or 10%. So I'm going to be a little bit more protective for right now. That being said, I wouldn't mind just throwing like a dollar allocation at it. Throw in like maybe a $1,000 to $2,000 position. If it goes up from here, cool. If it goes down, I'll just buy some more. Because I will say, I mean, we had a decent pullback here. This is the bear market of 2022. We had a 56% pullback, So is it possible from here that we have the same? Here's like a 30, here's a 40. I mean, we could still have higher lows. We could be pulling back into the, August 5th low. It's like, I don't know. I think I'm just going to wait. De-risking is about not necessarily taking on trades, even though I like the trade. I like Amazon. I've been holding Amazon for, years and years and years, but I don't think I need to force trades. So, all right, I'll keep going. Let me get some other comments here. I'll do some currencies in a little bit. Yep, we got some fresh highs in the day. That's good. Will, were you the one that asked me a question about that? Somebody messaged me about Aussie CAD. I'm just bullish on it with a big range. Somebody literally sent me a message and I responded. There's just a big range. Highs around 95 and lows around like 87. I'm just scaling in, looking for a big range to be traded. So I'm just buying like equal low levels, and I'll just trade the range back up to like 95. Okay. Broadcom sideways. Google. Oops. Google's hanging in there. A couple of dollar cost average levels. This one's looking good for income. I don't think I closed this trade out yet. This one's going out to next week. We're trading at 164. Let me see what this is trading for right now. I might be able to just take the profit on probably Monday would be fine. Let the additional decay happen. So if I go to Google right here, I did close it. So Google is another one that I added in. Yeah. So I've got a winner on Google. It was a 1-1-1. So I bought a put, sold a put, or it was a ratio spread. Let me see. This is a ratio spread. So Google was a ratio spread for profit. All right. So a lot of profits this week closed out with ratio spreads. Those trades have been set for 30, 40, 50 days. And I mean, I set them where I thought they would be safe. I pretty much had like a potential assignment at the delta that was like a 15 or 10. And even though we had this correction, a lot of it was lots of room for error. And even with the correction, I was able to absorb that and still close out for some profits. Meta probably still has room to the downside. I am curious, how this gets picked up off the 200 moving average. I do think it's a potential buy zone. I looked at this yesterday as maybe like another flush lower, but I just didn't think about the timing. I was like, if it went out 30 days, I'm not going to get the money that I want out of the trade. So I'm more interested in if it comes to the lows, maybe looking at a near-term bounce, going out maybe 1 or 2 weeks and then maybe grabbing a bull call spread off that 200 moving average on Meta. Microsoft, I did close this one out for a winner. This one is out to next week with a low at 370, which is even looking a little bit better now. So max profit at 240 per contract or the bonus trap. So that is Microsoft right here. So I did close out both of these. So this one closed for profit, this one closed for profit. And now I'm still holding this 421 expiration, which right now 229 is my max. And it's trading for, oh, there it is right there. 1, 2, 3. There's my March 21st. So my max profit's $2.40, and I'm going to close this thing down. This one's probably fine just to let it go over the weekend. 94.6%. I mean, that's my max profit. Do I have a profit trap on it right now? Kind of. I actually might be able to close this out for a credit. Nope, I guess not. Anyway, so I'm at 95% max profit. I collected 240. I can close it down for hopefully like a 12 or 13 cent debit. Let me see if I can get out of here for like a 13 cent debit. Be liquid. 14 cent debit. All right, 15 cents final offer. That gives me 225 net. All right, 15 cents closed out. So that's another winner on Microsoft. Okay, so closing out that winner for the 21st expiration. Same thing here. 1, 2, 3, and group this into a 111. There we go. Max profit 240, closing on hopefully 15-cent debit or less. Close 15 cents. I'll just let it sit there. I close this other one for 15. I'll let this one sit for 15. 1, 2, 3. Okay, same thing here. There we go. So 1, 2, 3, pending close. That one pulled in 240. Close it a 15-cent debit. Shares on that one. No exposure there. Just some shares. No exposure. This one will be another trade that has it. Here's a 111. Okay. I'll put a pending order in for 50. These should get closed out by today. I would think this can close out on its own today for a 15-cent debit or less. Over the weekend, it should definitely close out. If price just stays where it is and we go over the weekend, get another, Saturday, Sunday decay, and then Monday would come in with that final week expiration. It's got filled for 15 cents. So I'll get these filled up. This one, just some shares, just some shares, just some shares, and no exposure. Okay, so that's another winner on Microsoft. Cool beans. Netflix, I think I've got a broken wing butterfly in this one. Yep, it's a broken wing butterfly that is out to April. I'm looking for another flush to hit this 200 moving average. So even if we get a pullback here, high, low, lower, high, lower, low, my broken wing is all the way up here. So as long as we see this 200 moving average hit, this is likely going to be a full profit. There's also a profit trap in case we came all the way back to highs. I think I have a $5 profit trap. So pulled in 74 cents. If I get 74 cents, that's the income side. If I get the profit trap at highs, I'll make another 500 bucks ish. That's the window that I have. That's fine. Nike, that's hanging in there. This one, I think I'm closing out. Yeah, this is going to be fine. Just let it expire. So max profit's $1.72. I can't believe this one actually. So my max profit's $1.72. We're trading at $72, and I've got a 65 by 60 for next Friday's expiration. I don't think there's anything crazy. Oh, son of a biscuit. Nike earnings. Well, that sucks. Well, I guess it's not the end of the world. I don't know though, man. This retail stuff is not looking great. I think it's going to take the profit. So I've got a 65 and a 60 put. The retail earnings, I think, look, it's important that retail earnings are solid. I know if Nike considers my contribution to them, they should be fine. I bought like my one weird, like, I buy freaking shoes and I hardly ever wear them, but I like them on sale and I get a ton of shoes and I just take them back and swap them. And anyway, my retail side of Nike's been very well supported. But $72, I mean, 65 should be outside of the expected move. I mean, to the downside, you can see like right there, potentially if we had like a, 1+ standard deviation move, maybe I would take on some assignment on Nike. But I'd also be owning it. If I took on any assignment, I would be owning it near the freaking COVID low. So, I mean, that's how bad it would have to be essentially. It's like, well, I own Nike at COVID lows. Is that a bad thing? Probably not. But then how does that get worse? Well, it's Nike's down X amount of percent. It'd be down 66%. And it's like, well, now China's going, I don't know. So probably better safe than sorry. My max profit's $1.72. I'm up $60. I can just I'll take this one probably off the table on the weekend, although there's that swelled volatility that may not let me get more than what I already have out of it. So I think I'm just going to close it and not worry about it, which is kind of annoying. But for me, the trouble of like if we have a bad earnings and I got to repair this and tie up, potentially 12 grand in cash, I don't really want to do that. So I'm just going to take the whatever, 40% profit and move on. Okay, so let me see what this is trading for. $1.72, and it's trading for like $1.15 or so. Let me see if I can get out of here with $1.15. So if I get at least $1.20, I'm fine with that. At least grab $50 out of it. Could be worse. Come on, man. That's the freaking ask price. You jerks. Filled at $1.19. Okay. Let me double check and see if I have any else with Nike exposure. I'll have a few accounts here. Same thing. $1.19 debit should be filling. That's $1.72. Close it out for $1.19. Well, now the ask is $1.18. $1.18, $1.19. Filled at $1.19. Nike, nothing in here. Nothing in here. Nothing in here. Closed out for profit there. That's going to be added into the winner. Nike, cash secured puts for profit. And I think that's all I have in the Nike exposure. Nothing there. Nothing there. Nothing there. And I'm still willing to have some Nike shares if we have I hope we don't have a bad earnings print. A bad earnings print probably smells more trouble ahead because retail sector's down. People stop buying freaking sneakers when they're strapped for cash. You don't need to drop. Sneakers, I don't know if anybody pays any attention to this stuff. Sneakers are ridiculous. Like since COVID, it's like the dumbest market. There's like StockX, there's GOAT, there's all these like aftermarket. You see a Nike shoe for $100 and now it's on a third-party website for 125, 150. You got to auction for it, and then they charge you $40 for shipping. It's like, what is this? So anyway, stupid market. But if Nike has a bad hit for retail, it is like 60+% down. I do think fair market value and brand recognition wise, like Nike's probably fine. I just don't want trade tariffs and retaliation stuff to make it worse because that probably could be the next thing. So let's see. I'm going to see where fair market value is in Nike, and then I think I'll let you go. Reliable dividend. Cool. It is trading at a 22 price to earnings. But legitimately, this is why I would say I don't need to own any Nike. COVID lows are great, but when current price is 70 and change and fair value is 40, Nike can fall a little bit longer. So yeah, if we get below COVID lows, I'll revisit this conversation in Nike. But this trade is now done, closed for $1.19 debit. So that trade's a winner. Okay, what else? Home Depot. Yikes. Yeah, it's kind of just a big range. I would maybe consider this one back in the 280s. This is big projects. This is a bit of the consumer side, the retail side. Not a good look, and especially with something like Home Depot where people like the average ticket item at a Lowe's or Home Depot is much higher than buying shoes on Nike, or buying American Eagle or Abercrombie and Fitch, but the retail side hasn't been super awesome. So if this has more to drop, I would welcome Home Depot as much as I don't love seeing the stock market drop. It's like if we're back down to 280s, then take a look at HD and see what's fair market value, right? Fundamentally looks pretty good. Trading below estimated value for earning forecast to grow, pays a reliable dividend. That's good. Debt, okay, fine. It's all about debt servicing at this point. 23 times price to earnings. That's a little high, but Historically, I'd be actually curious to see what that historically is shown. Price of sales at 2.2, but current price, I mean, this is what I wouldn't mind. If the retail side gets beat up bad enough and this price drops to like 285, and you've got fair market fundamentally showing 378, I think that's a good trade. But I think there's more pain ahead. I'm not trying to catch a falling knife at like, oh, I can get $30 upside. Look, I'd rather see this thing fail miserably and then give me $100+ of upside. That looks a lot more. So if it drops, sorry for Home Depot, but good for us with opportunities. Lows, same thing. Pulls back into maybe this like 180 to 190 zone. I like that as well. So somewhere in here for some structure. MasterCard, Visa, Amex. This is one. I've got a couple ratio spreads. This would be another one to have that like short-term relief. Amex to me, I'm looking at like the top 1 to the top 10% of earners. That's your like higher demographic, earners, mostly your Amex people. If they're going to continue to spend, there's resiliency with the consumer, then this should be able to pop up into the 200 moving average, maybe slightly higher. Just look at this from a fib. There's a high, there's a low, pull back a little bit, maybe. So my ratio spread is a 270 by 260. So my assignment level wouldn't be until 260. I have a $10 wide. Is that right? That's a crazy freaking trade. So, I mean, on a positive note, let me go to AXP here. So I have an April. Yeah. So, I mean, I pulled in 91 cents. And if I took any assignment, Amex would have to be below 260. And I also get a $10 bonus trap. And I get the 91 cents credit. So my break even on Amex, and this is probably what I'd be willing. It's going to be crappy to own it just because it's fairly expensive. But 260 minus 10 minus 91, I would own Amex at 249. 249. To me, owning this at 249 would be at fresh lows. That's a 23.5% discount. I'm not saying it's a great trade, but I think I could at least own it and repair it pretty straightforward. So between these two, 91 cents and $1.89. This one is the same type of trade through May. I was looking at this one more for like the seasonality of like May, June, July, August. So if this market stops bleeding a little bit through next week at FOMC, we maybe finish the quarter trying to fight back a little bit, then yeah, I'll look and see how these play out. Okay. All right. I'm almost done here. We'll get into some currencies. Johnson & Johnson. I'm in the healthcare space with a 130 put. PGR right back. Look at that. Freaking stock right back up to fresh all-time highs, man. So I had a ratio spread on it, worked out really nicely. I'm still in CB until May. I'm looking at that one. That's working out pretty well. I think I'm actually in some profit already. So CB, $2 and I'm up $142. So it's about 71% of the max profit, but there's plenty of time to just let it pay me more. Palantir, not even interested. Ratio spreads are fine. These are already in a majority of profit. I think I got rid of some of these. Palantir. So yeah, I mean, I'm up $638. This one's out a couple of weeks. Let me see what max profit is. $1.41 trading for $1.20. $1.85 trading for $1.30. And they got a bunch of dirt cheap puts on this thing that just need more time. So yeah, I mean, this is why I didn't chase Palantir last year, because I positioned myself for, if this thing wants to go up, I was trading in like the 30s and 40s and 50s, and it ripped up. And I mean, I think there's a lot of potential like reality of Palantir coming back down, but this is still in the S&P, or this is in the NASDAQ, and I mean, I think this is like you're getting more and more companies with like kind of government. This is the stuff like maybe government contracts hurts Palantir, maybe the Doge agenda hurts Palantir. I don't know, but we'll see. Either way, right now I'm just going to sit on some profits, and I think I've got plenty of space until this becomes a problem. What else? Carvana, meh. Salesforce, meh. O'Reilly Auto Parts, the little tiny brick and mortar that is a $1,300 stock. Who knew? Redfin Zillow, Redfin, what? That's crazy. That's a big rip on old Redfin. Just didn't even hit support for me. That sucks. It'd be fun to have a stock go from 5 to 10, 5 to 11. Was it even earnings? Nope. How did that go up? I don't know. Zillow, just real estate, sectors and currencies. I'll go for just another like 4 minutes, power through it, and I'll let you go. Okay, I think I'm still good for my calendar. Let's see here. Okay. All right, Aussie CAD. This is the range that I was looking at. Resistance here, support here. I'm buying, I'm buying, I'm buying. This is why I'm long. I'm just establishing positions. If this starts to go up, 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 that's totally fine. Get back to 94, 9,500. If it starts to go down, let's say this is range, and this is just high to low, a little bit of a pullback, and then we make another push lower. I'm still going to buy, I'm trying to trade this range. Like, to me, this is a range trade. I would even buy this thing all the way down to this low. This is a currency pair that I rarely ever worry about when it comes to efficiency. It finds pivots, it finds inefficiencies, it finds pockets. I just trade this one really small and just kind of work through my levels. So the reason I'm long is because it's a slight positive carry to be long Aussie versus CAD. Aussie Swiss, I'm still long. Aussie yen, no trade, but watch these flash crash lows for a potential bounce. If there's another risk on rally that is coming, the Japanese yen might be able to signal that as well. If we see a weaker move in the yen or the Aussie yen that it's not perfectly correlated, but it does track the S&P 500, the Aussie yen going to the upside could be a good sign for the markets to go higher. Aussie New Zealand, I'm still bullish on that one. Aussie dollar, I'm out of the trade. CAD Swiss, I'm still bullish off those lows. That's a beautiful entry, by the way, right here at these flash crash lows. I think this one rebuilds its way back to these center highs. Not saying there's not risk to the downside. This one I'm trading small, but I think we get back to 64. If we double this move doubles, that's a big fat payout if we get to 6,700. This is why I'm holding. I mean, there's pockets here. There's structure here. Like, I am holding this CAD Swiss stubbornly, but small and manageable. But yeah, I mean, if this reverses into some type of bullish pattern, I mean, frickin' sign me up, man, and give me a 5-wave move. So I'm going to hold CAD Swiss long. CAD yen, again, watch the lows if we react off that flash crash level. Swiss yen, no trade. Euro Aussie, we talked about the 1,000 pip move, just expecting a short-term top. I'm not trading it. I'm just just making traders aware of it. Euro CAD, same thing, just went ballistic. Aussie, CAD, New Zealand beat up so badly these last couple weeks. Euro Swiss still looking pretty good, up to some fresh highs. Euro pound, huge squeeze on the euro. I mean, I was long in this one when we had this first pop. So long here, the 200 moving average, and took some profit, and that was it. Rest of it's just trading robot style. Euro yen, because of the euro rip, that was right off of those flash crash lows in August. That was a nice trade if anybody's paying attention to it. Euro New Zealand, pulling back, totally fine. Short-term time frame gave you the confirmation. Just because we went 1,000 pips up, it's going to fall. I don't know how much, but if it goes from low to high, pulls back to like 38%, pulls back to 50%, in the near term, that leaves some opportunities to see some bearishness. Okay, euro dollar. It's the dollar index, right? If we're going sideways here, this little rip to the upside, if it goes sideways and there's another push coming, that would be the dollar index going lower. Dollar index goes lower, euro dollar probably goes higher. So I'd say that the euro is still really well supported into this zone. Even if it pulls back to like 106, if it bounces here, I'd still be willing to take that trade. If the dollar continues to get weaker and this just pauses, then the euro dollar keeps going. Look, that's a big move. If we go from 102 to 112, 1,000-point move, if you've got some inefficiencies here, I hate to say it, but I'm going to sell that euro dollar back into this candle. So let me change the color. If we go up to 112, and there's this giant inefficiency here, I'm going to look for confirmation similar to this top right here, like something. Give me some type of topping pattern, and then look to sell this thing back down into this pocket. So it's either pullbacks with confirmation to go higher, pullbacks with confirmation to go higher, or we just magically see it at 112 and I'm looking for a chance to short it. Okay, pound Aussie ripped up, short terms pulling back. Pound CAD ripped up, short terms pulling back. Pound Swiss, I'm still bullish on that one. Pound yen, no trade. Pound New Zealand, same thing, ripped up, pulling back in the short term. Pound dollar, no trade. I don't like it. New Zealand CAD, I'm still holding long. Same thing here. This is my range. So I'm leveled in, and I'm going to level in. I'm going to trade it back to range highs. So I'm bullish on this one, and I'd level in if it pulls back, but I'm looking to basically get out at like 86 to 8,800 on the New Zealand CAD long. New Zealand Swiss, I like this one as well. Turning off of the flash crash lows, we want to see a bit of a bullish pattern to have some more upside, but even doing this, if it takes out the structure high, a pullback here would be a good chance to get a 5-wave move back to these levels. I really like this trade for target 1, and I love this trade for target 2. Another reason I'm still invested in these stupid Swiss pairs, it's like, well, it's 3 to 4% on just holding, and hopefully now that we're at these positions, we just have lots and lots of pip appreciation. Time will tell, but I'm willing to wait. New Zealand yen off the lows, trade with caution, but maybe that response right there at the August 5th bottom. New Zealand dollar, I'm still hanging on to this one. See if we get back a little bit higher and weaker dollar. Dollar CAD, I want nothing to do with it. I had my great trade on dollar CAD, was long from 34 up to 45. I'm good. I'm out. Dollar Swiss, I want to see deeper pullbacks. If we get to like 86 or 84, I'll add more to it. Otherwise, no trade in this one. That was another like great trade from the lows to the highs. Dollar yen, possibly a pullback. If we pull back into, let's say, 152 or so, we could possibly pull back into the 154s, but this does look like a pretty difficult pattern to ignore. If we have this range high and we have this range low, if this is forcing a topping pattern, don't be surprised for some, Japanese yen drama later this year. So, all right, that gets me through all my currencies, to get through all my stocks. Thanks for being here. Happy Friday, and see you next week. Thanks.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want more from A1 Trading? Check out the links in the description below, or our website a1trading.com. We have lots of free trading tools and channels available for you. We hope you have a great rest of your day, and we'll see you tomorrow.